Hey, it's Stuart. My question of the week is from Darren. Darren writes that he's got a significant amount invested in the US stock market, and one thing that's causing him concern is the potential for the Australian dollar to rise. At the moment, it's trading around 66 cent US cents in the Australian dollar, and he's concerned that if it goes beyond, say, 70 cents, the value of his investments in the US will deteriorate. To add a little bit more complexity, he's getting pretty close to retirement, and he's asked me what does he think he should do, given that he's going to retire in the next couple of years. And this topic of hedging is a really important one, and one that can be quite confusing. When you look at the long-term studies, they tell us generally that hedging works its way out over the long run, which means it doesn't really have a big influence on returns and the success that someone might have with investing. Because as you can imagine, there's going to be times when the Aussie dollar is trading at 60 cents, at 70 cents, at 80 cents, and it's all swings and roundabouts. If we're investing over periodically over that time period, we're going to invest sometimes when the Aussie dollar is attractive and it's at 80 cents, and we're going to invest in times when it's unattractive at, say, 60 cents. Now, the whole idea is that at the moment, the Aussie dollar is trading at 66 US cents, as I said. Now, if it appreciates by 10%, and say the Aussie dollar is then trading at 72 cents, the value of my US investments in Australian dollar terms are now worth 10% less, because the value has increased. The Aussie dollar has value. So the thing that we like to think about in our business is the investment of new capital. If we're going to invest new capital when we think the Aussie dollar is below the long-term trend, and the long-term trend's around about 70 US cents, and so at the moment it is, and if it's trading at 65 or below, we would typically hedge. And that way, at least we know in the long run, it's probably not going to have a huge impact on returns, but in the short run, at least we get to maximize our returns, and we don't get a situation where we invest some money today and in a year's time we've lost 10%, not because the market hasn't done well, but just because the currency has changed. Similarly, if we're investing new money and the Aussie dollar is trading at 80 cents, which is well above the long-term trend, we would definitely not hedge. We would want to enjoy some of that currency depreciation in terms of its appreciation on our investments. Otherwise, if you're a long-term investor, particularly inside super, which most of us are, you probably don't need to worry about hedging too much. It's just if you're going to invest a lot of money, or a significant relative to your balance amount of money, then you might just want to consider where is the Aussie dollar at this point in time. And if it's relatively low, relative to the US, well, then hedging's probably the right way to go. And if it's relatively high, then definitely don't hedge. And if it's trading around 70 cents, again, you probably wouldn't hedge either. It's probably okay to sort of ride that currency out. But obviously what hedging tries to do is it tries to eliminate the impact of a movement in currency. Now, a lot of hedge products won't do that by 100%, but they'll greatly reduce currency fluctuations what currency fluctuations have on the performance of a particular investment. So, Darren, in your situation, what would I do? If you have a large exposure to the US, and I don't know what other assets you have, but if you're getting closer to retirement, then I would argue that you've got less appetite for volatility. That capital preservation is arguably more important than investment returns. And if that's the case, then if you can reduce your US exposure or hedge some of it, that might be an okay thing to do in your situation. But it's going to depend also on capital gains tax. If you've got a significant exposure to the US market, then I'm going to assume it's done pretty well over the last 10 years if you've held it for that time period, and you're probably facing a bit of capital gains. If that's the case, then you could hang out until you retire to try and minimize your capital gains, but the cost of doing that could be that the investments are worth less by that time. So I think it's a case of potentially selling some, so reducing some of your exposure, but maybe not as much as you would if the capital gains tax wasn't that prohibitive. But it's a great question around hedging, Darren. I get a lot of questions about it, and there's a lot of confusion. In the long run, it doesn't make a big difference. It's just in the short term to try and protect our capital and protect our investment returns. We'll use hedging when the US dollar is, the Aussie dollar, I should say, is trading at sort of around 65-ish cents. Anyway, I hope that helps. Great question, and thanks for sending in, Darren. Cheers.